Welcome to the National Credit Awareness and Resolution Association podcast at NCARA.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use creditor tools, specifically the commercial real estate lending evaluation. NCARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Commercial real estate, CRE, collateral considerations and risks. CRE risk, the office market in particular, is getting plenty of attention these days, and rightfully so. The CRE market is likely to be pounded over the next couple of years, primarily due to high interest rates and operating expenses, lower occupancy, increasing refinance risk, resulting in turmoil, frankly. Lenders, CRE concentrated regional banks in the U.S. in particular, will be taking an intense look at loans secured by commercial real estate. How about your commercial real estate loan? You should already have a copy of the most recent appraisal on file, so you have the same information as a lender does. But I want to take you through the following points for you to consider as you prepare your own debt repayment solutions if it involves commercial real estate. First, relevant market conditions and their impact on the borrower. Lenders analyze how market conditions during an economic downturn impact CRE borrowers. This includes all things like declining CRE valuations, inflation, increasing interest rates, employment rates, borrowing costs, increasing vacancy rates, decreased lease rates or rental rates, increased operating expenses, decreased demand for CRE, lack of available financing, and less economic growth. They determine how these measures affect your ability to repay. So use these to build your case, whatever that might be. And in an appraisal, you'll notice that there are things that are called extraordinary assumptions. Stakeholders, including the appraisal review function, this is at the lending institution, analysts and underwriters, even the primary relationship officers and credit administrators will need to read or thoroughly understand any noted extraordinary assumptions in a CRE appraisal report. Such assumptions are important and may include, for example, things like the following assumptions: that the property is free and clear of zoning violations, structural defects. In other words, they're assuming that it's free and clear of these things, like any encroachments or easements or liens or title defects or flood risk or fire hazards, mold, termites, environmental contamination, hazardous materials, asbestos, radon, lead-based paint, sinkholes, soil contamination, water damage, foundation issues, roof leaks, and so on. But your job is to make the lender aware of, or in fact document, what is happening and close any gaps of mutual misunderstanding that there might be for any of these assumptions. Next, let's look at hypothetical conditions. Stakeholders, including the lender's appraisal review function, again, they're analysts, underwriters, all the loan officers and credit administrators, they also need to read and understand any noted hypothetical conditions in a commercial real estate report. And this goes for you too. And these things include, for example, the following conditions to which the subject property may or may not be subjected to. Any of these things can happen. It's a hypothetical. For example, clear title, legal disputes, pending litigation, zoning changes, environmental conditions or regulations, building code violations, easements, liens, encroachments, leasehold interests, mortgage interests, restrictive covenants, adverse physical conditions, adverse economic conditions, adverse legal conditions, and adverse legal market conditions, even political conditions, adverse social conditions, or any adverse technological conditions. Again, make the lender aware of everything that's going on, because it is what it is. So if you're aware of any of these things, put that as part of your repayment program. The next thing up for consideration would be the leases or the rental rates, the vacancy and operating expenses. Lenders are going to have to review they will review the current rental rates and compare them to market conditions, in other words, the interest rates in the market, tenant demands, zoning. They will similarly analyze vacancy trends over time, its impact on your borrower's income, and the root causes for the higher vacancy. They will anticipate changes to vacancy rates as well. They will observe material increases as a percentage of gross income, the operating expenses. They seem to be going up a lot, and determine the reason for their increases, including things like improvement to the property to attract tenants and maintain and prevent deterioration, reflect changes in the market, tenant demands, zoning regulations, and so on. They will also project any other material changes with supported and documented analysis. Give them the answers they're looking for. They need to know too. Next, look at capitalization rates or cap rates, the ratio of a single year of net NOI or net operating income to the property asset value. In an increasing interest rate environment, as cap rates also increase, creditors will analyze the effect cap rates are having on CRE valuations. In a down economy, the cap rate will increase as stakeholders become more risk adverse, thus making it more difficult to obtain financing, even resulting in lower CRE values. Lenders will analyze and document how the creditor's exposure on such CRE collateral needs to be handled. They will consider additional lender and borrower risks for current market conditions, credit, liquidity, collateral valuation, environmental, legal, zoning, construction, tenants, management, etc. How about next, the discount rates? The investor's required rate of return, discounting future cash flows during the holding period back to the present value or the present to determine the value. In a down economy, the cap and discount rates tend to increase, and both rates share these risks. Lenders will focus on other risks leading to default risk, foreclosure risk, where the lender must sell foreclosed properties in a down economy. Take a close look at absorption. Lenders will understand the rate at which commercial space is being leased up into the subject market. They will review the original appraisal absorption assumptions and compare that with the current demand for similar space today in a down economy. Absorption rates will be lower as properties will take longer to sell, leased at lower prices, require more marketing or incentives like rent concessions, and tenant improvements to attract tenants or buyers. Lenders will also conduct a physical inspection of the property and identify any significant needed repairs. Also, and especially in some areas like Hawaii, take a look at the leasehold interest. Lenders will confirm the remaining length of the leasehold interest along with rent escalations for reasonableness. The loan structure will be adjusted if the CRE is truly a wasting asset and when it becomes of no value upon expiration of the lease. Loan, of course, is going to be repaid well beforehand. Next, look at tenant improvements or TIs. Lenders will carefully analyze the lender finance TIs, whether they are cosmetic changes or major structural renovations. Repayment will or should be aggressive since the lender is effectively unsecured and without any realizable collateral. How about an appraisal recommendation, like for a new appraisal or a validation of an existing appraisal or simply an evaluation, which is another form of an appraisal, basically. Based on relevant or material changes in market conditions, project performance, geographic conditions, variances from original appraisal assumptions, change in project specs, loss of lease or takeout, high pre-lease fallout, and especially as your financial condition deteriorates, a new updated valuation will be procured, likely at your expense too. This short ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at tunabudget.com to tune in to the Debt Crisis Problem Podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Please join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. CRE lending consideration and emerging CRE risks. Everybody is closely watching new emerging risks in the CRE marketplace for all property types, whether they're office, retail, industrial, multifamily, hospitality, healthcare, and other special purpose properties. Of course, much is dependent on things like location, size, tenant mix, etc. There are trillions of dollars in CRE loans that will need to be either repaid or refinanced in the next couple of years. Consider these risks and how they will affect you and your business. Number 1, interest rate risk. Higher interest rates result in higher borrowing costs, making it more difficult for you to repay or obtain replacement financing. High interest rates can easily result in a higher likelihood of default and foreclosure. Lenders will look for any possible mitigating strategies for managing interest rate risk by using interest rate swaps, exchanging a variable rate for a fixed rate, and lenders will also cap interest rates to limit increases or maximize costs, or have floor rates that provide a minimum borrowing cost at your expense. Next, refinance risk. Higher interest rates have a material impact on refinance risk. With the increased cost of borrowing, it becomes more difficult for you to refinance, possibly leading to payment default and collateral liquidation. The property's value may become reduced and even make it more difficult to refinance. Lenders will pay close attention to the earlier resizing opportunities before refinance risk increases too far, including closely monitoring interest rates and market conditions, your credit worthiness, upping guarantees, and having you give additional collateral. As this takes place, lenders will determine if outside financing is even possible, if your loan risk rating will need to be downgraded, or your loan extended with disclosable modification terms, or if the collateral should just be sold. You may take measures to improve your creditworthiness and the property value, reduce your debt levels, increase cash flow, obtain an additional interested guarantor, of course that has consideration, provide more collateral or higher guarantee percentage, or offer and negotiate a workout or loan modification. What about those resizing opportunities where you pay down the loan? Commercial lenders will determine if a CRE loan needs to be paid down or resized by considering various factors such as a higher interest rate environment, reduced net operating income (NOI) due to decreased rents and higher operating expenses, declining economic market conditions, lower debt yield, weak forecast, poor liquidity, uncertain repayment ability, etc. The lender will document the case for a resizing opportunity by using repayment tools like your debt service coverage ratio, loan to value, debt yield, and stressed interest rate sensitivity, and propose and document a resizing paydown recommendation. It will put the interests of the creditor first, and your interests second, unless you prepare and propose your own repayment solutions. Let's take a closer look at repricing risk, the possibility that a CRE loan may need to be refinanced at a higher interest rate upon maturity. Especially in an economic downturn and high interest rate environment like we have now, rates should cover, the rates will still need to cover, it has to be high enough so that the lender can cover its cost of funds and loan servicing and any probable loss and also have a reasonable profit margin. So it's probably going to be higher. When pricing for risk, lenders will keep these things in mind, including when your credit worthiness, income, and the collateral property value have all declined. So how do you reconcile that? That's called repricing risk. The repayment risk has increased, so which way should the interest rate go? And let's add more risk just for fun. When you've lost a major client, supplier, employee, a large contract, customer or vendor, unless you're really in trouble, repricing risk will likely go up, so don't be shocked at a higher rate. unless you're really not in trouble. Repricing risk is going to go up. Physical inspection is another tool. Lenders will identify potential risks by conducting a thorough physical inspection of the CRE. They'll start with reviewing the loan documentation, the title, the survey, the zoning, to learn of potential legal issues. Their visual inspection will include the interior and exterior of the building and the site to document any potential physical or environmental issues to avoid potential liability there. They will review your balance sheet, income statement, and property lease agreements, and note any other issues or questions with follow-up discussion with you. They may even conduct regular inspections, especially if their collateral consists of inventory and accounts receivable. They won't forget identified issues either. They should get your authorization to conduct all inspections, obtain necessary training, use proper safety precautions, and ensure proper supervision when they're out on site, if necessary. Let's talk about insurance coverage, the type and the amount, the timing, claim acceptance, doubt, and protracted resolution. Hazard and fire insurance coverage should help protect damage from fires, natural disasters, property, general liability, business interruption, equipment breakdown. Lenders will review the adequacy of insurance coverage for loans secured by CRE and determine how sufficient it will cover the cost of repairs or replacement in comparison to the actual outstanding loan balance. If the land value is excessive, the cost to replace the damage may be less than the loan balance. They will ensure the policy is in force and has not lapsed. For claims, the insurance company will investigate the validity of a claim to confirm the destruction was caused by a covered event. They will work with legal counsel if the claim is doubted, or if the claim resolution is expected to be protracted. Let's take a look at environmental risk. Okay, let's end with that one. The lender inspection, borrower questionnaire, a base review, Phase 1 and Phase 2 environmental site assessment reviews. That's all environmental risk, due diligence. Lenders will ensure that it has conducted sufficient environmental risk due diligence, including an environmental lender inspection, borrower completed questionnaire, and obtain a Phase 1 environmental site assessment, an ESA, or if necessary, a Phase 2 ESA, as I said, if necessary. It will review documentation to confirm your responsibilities with respect to environmental compliance and any remediation, considering the use of environmental indemnification agreements to shield the lender of potential environmental claims. These are all tools and due diligence requirements for any CRE loan. Thank you for joining us. Today we covered the creditor tool, commercial real estate risk. As debtors prepare to propose their own repayment solutions, we want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at nicara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.